I didn't think I'd be doing a video on this today. I even stopped filming a different video because of the importance of what is happening right now and how it most certainly will affect you as an investor. The controversy surrounding GameStop and Robinhood, along with other brokerages that halted trading of the stock, are an implication to how the stock market functions, how it's regulated, and is likely much more important than most people out there realize. As we get started, if you're wanting to inform the average investor, help this video get traction on YouTube by clicking that like button. The simple act of turning that like button blue can help this video reach other average Joe investors like us, so they can get educated on the actual working of the big money institutions. Thanks again for getting that out of the way. Now let's get updated on what's going on. I'll just be doing a brief explanation of what's been happening so you're all caught up to speed. And then I'll move directly into the current events of the Robinhood lawsuit that most everyone should be concerned about. GameStop, which I'm sure you're familiar with as a retail gaming store that has slowly been losing business over the last several years as people move more towards buying games through online downloads. Changes in consumer purchasing behavior moving more online has already resulted in other large retailers like Toys R Us and Blockbuster to fail. As a result, hedge funds and other institutional investors thought that GameStop was destined to follow the same path of inevitable decline. These large investors then decided to short the stock of GameStop, which essentially is to bet against the company's success. But these hedge funds didn't just make reasonable bets against GameStop. They shorted GameStop to extremes, shorting more GameStop stocks than even existed on the market. Reportedly, there was a total of 113% of GameStop stock shorted. Combine that with these hedge funds' media influence, and you can imagine the price of GameStop had likely dropped artificially. I know what you're thinking. How is it possible to short more stocks than exist on the market? I'll quickly explain. Shorting is when an investor first borrows stocks that will later be returned to the owner. The investor then immediately sells those stocks and waits, hoping to buy them back at a later time for less money. Once bought at a cheaper price, the investor returns the borrowed stocks to the original owner and pockets the difference. Now, this is how that same scenario can result in the shorting of more than 100% of a stock. Investor A allows Investor B to borrow their stocks. Investor B immediately sells those stocks to Investor C. Investor C allows Investor D to borrow the stocks. Investor D immediately sells the stocks to Investor E. You can see how that same stock can be short sold twice over without the buyer or sellers even knowing. So now on to the good stuff. There are dangers when shorting a stock. If you invest normally, the worst that can happen is the company fails and you lose all the money invested. Well, since there's no limit to how much a stock can go up, there's no limit to how much you can lose shorting a stock. So if you bet against a stock that goes up, it can lose more money than what you have invested. Since you're borrowing the stock, you'll need collateral for at least the value of the stock you short. Unfortunately for these hedge funds, GameStop had a mix of positive news that left the general consensus of investors questioning the ultimate failure of the company. This weakened the artificial deflationary bet they pushed on the stock and resulted in an increasing stock price. To add insult to injury, some average investors recognized the recent good news about GameStop and the overshorting of the stock by hedge funds and shared their findings in an investment forum called Wall Street Bets. They supposedly coordinated an effort to publish their expectations of GameStop's potential growth and made others aware of the hedge fund's extreme short positions, ultimately driving up the stock to inflated levels. You see, if there's an overshorting of a stock, it creates a supply and demand issue for the hedge funds who borrow the stock with the intention to buy it later, essentially letting stock owners demand whatever price they want from those holding the short position. As the stock went up, there was even more interest by average investors to buy GameStop stock, further increasing the price of the stock. If the stock goes up too much, the hedge funds wouldn't have enough collateral to cover the value of the shorted stocks and would need to close their position, further increasing the price of the stock. This is what is known as a short squeeze. A short squeeze is when investors try to inflate the price of a stock so those shorting don't have enough collateral to cover their borrowed position, resulting in those shorting needing to also become buyers of the stock at a loss. That's the current pressure on these hedge funds. They are set to take massive losses in the stock market, now amounting to nearly $20 billion already in the last month. It's important to note that much of these losses are not realized, meaning that these hedge funds are holding these stock positions waiting for the stock to drop again. But shorting isn't free to hold. These hedge funds have to pay interest on the value of the stocks borrowed, which means they likely can't hold it indefinitely. Some of these large hedge funds are now crying foul, saying that individual investors have falsely inflated the price of the stock, even after they themselves may have caused it to artificially go lower. We need to remember that these same hedge funds make price predictions on stocks they purchase or short. Knowingly, they could potentially influence public opinion and the stock price. Think about it. Why is ARK Invest permitted to announce a price target on Tesla, which garners media attention reaching tens of millions of people in a matter of hours, but random individuals on Wall Street bets are now facing scrutiny for attempting to do the same for GameStop? Some consider the cry from hedge funds to be hypocritical, and comes at a time when they lost at their own game to a band of small-time investors, wanting us to be regulated while they continue their pump and dumps, or as they like to call it, price prediction and profit taking. You should understand that stock exchanges like the NASDAQ will sometimes halt the trading of a stock when its price fluctuates significantly outside of its fundamental value. The idea is to let investors cool off in hopes that the price will stabilize. Meme stocks and those discussed in online forums are particularly known to experience significant fluctuations that would normally result in a halt on trading. GameStop has been no exception to this. Their stock was halted from trading several times on Monday and Tuesday of last week. The Nasdaq CEO has now come out saying they will halt the trading of a stock if they link unusual activity to social media chatter. But what efforts are being made to stop the possible manipulation of stock prices by hedge funds, who have immense access and influence over professional media outlets? How would any of this even be measured and regulated? There's no way a company can even begin to prevent such speculation and discussion from happening about their own stock. And who is it to say definitively if a stock is overvalued? They might as well say they will be deciding which investors and institutions get to manipulate the market. Let me take a moment to explain that this whole video is just entertainment and my own personal opinion. Don't construe it as being fact or advice. Now moving on. If the Nasdaq's CEO's statement wasn't troubling enough to some investors, on Thursday, January 28th, Robinhood and other brokerages halted the trading on GameStop and a few other companies that were having high volatility, particularly halting the buying but not the selling of the stocks. It should come at no surprise to anyone that GameStop's stock price dropped like a rock when buying halted, but selling was still permitted on several platforms. This led to a class action lawsuit against Robinhood, claiming their actions were done purposefully and knowingly to manipulate the market for the benefit of people and financial institutions who are not Robinhood's customers. As defined by investing.gov, market manipulation is when someone artificially affects the supply or demand of a security, causing stock prices to rise or fall dramatically. Some may have argued that Robinhood interfered with the natural price discovery of GameStop's stock, directly influencing its price to drop and thus harming Robinhood's customers who owned the stock. Robinhood responded to these claims, saying it was to stay in compliance to net capital obligations and clearinghouse deposits. Again, I want to remind you that everything in this video is for entertainment. It is all based on uninformed opinion, and you should not take it as fact. You're probably wondering what, if any, would be Robinhood's motives to take action on certain volatile stocks, besides the reason they gave in response to their actions. After all, disabling the buy button on a publicly traded stock is a pretty big deal. And here's where investigation really needs to take place. Robinhood's regulatory filings show they make large amounts of money charging investment firms fees for real-time data on their users' buy and sell orders. You know the age-old saying, if you're not paying for the product, you are the product? Robinhood routes the majority of all their customers' stock orders through Citadel Securities, meaning that when you make a trade on the Robinhood app, it is actually outsourced instantly to Citadel, who then executes that trade on your behalf. From this, they're able to collect your trading data. Here's where the suspected collusion may have taken place. It just so happens that Citadel Securities is ran by Kenneth Griffin, who also runs one of the largest hedge funds in the world. And him, along with his hedge fund, invested more than $2 billion into Melvin Capital, who lost more than 53% of their portfolio in January from short squeezes on several stocks, one of which was GameStop. Lawmakers across the aisle are adamant about holding a hearing that would investigate any communication between Citadel and Robinhood, and reviewing anything that may implicate Citadel from having an influence on Robinhood's decision to halt the buying of GameStop stock. But a deeper look may indicate something much less devious, and the true reason why these brokerages stopped selling GameStop. It may all very well come down to the broker's ability to clear the executed orders. You see, when you buy and sell stocks, that money doesn't instantly change hands. While you may see the change immediately in your personal account, the money and the stocks have to cross through both the brokerage and the clearinghouse before it is finally settled roughly 2 days later. The clearinghouse has a pivotal role in the efficient movement of stocks in the marketplace. They provide a guarantee to both the buyer and the seller once the deal has been executed, not just acting as a middleman, but literally taking over both sides of the contract, contracting individually with the buyer and individually with the seller. The buyer will receive their shares even if the seller doesn't deliver, and the seller will receive their money even if the buyer doesn't pay. This requires the clearinghouse to have collateral on hand to cover these transactions. Deposits need to be made by the brokerages of the buyer and seller to the clearinghouse. The brokerages use their own money for this, and normally only need to put up a portion of the trade value as a deposit, let's say 10%. But if the stocks are highly volatile, more deposit money or even a full price deposit may be required, money which the brokerage may not have. This is exactly what happened with GameStop stocks. The Depository Trust and Clearing Corp required a collateral call of 100% on stock purchases. Robinhood stopped trading to preemptively avoid the risk of a liquidity crisis, while they worked to raise $1 billion to resume trading of GameStop. And to be fair, other brokerages also halted trading of GameStop for similar reasons. You can now see how both the brokerage and the clearinghouse take on risk when executing trades of volatile stocks. They are the ones hung out to dry if either the buyer or the seller defaults on a volatile stock whose fundamentals don't seem to match the stock's current price. Whenever people see a rare event in how the stock market functions, there are bound to be some complaints. Honestly, I don't see much coming out of the Robinhood lawsuit. It seems they are well protected with their user agreement, and they have sufficient reason as to why they briefly halted the trading of GameStop. And let's be honest with ourselves. GameStop was likely way overvalued when they did halt purchases. I also don't think it's likely any new regulations will be put in place either, at least not at the present time. If this continues to happen over and over again, then I see the SEC making some new rules. I might be wrong about this. The SEC might be more proactive about regulating the shorting of stocks than I expect. But there will definitely be pressure from hedge funds to leave it as it is. And I don't see how the SEC could even begin to regulate social media chatter. It's really impossible to say how much reach or influence someone's opinion on a forum has on purchasing behavior. It would require a level of data that the SEC likely doesn't have. Now for what I do expect. I do expect hedge funds, regulators, and stock exchanges to keep a closer eye on popular stock trading forums and social media groups. From this alone, certain inefficiencies in the market will likely work themselves out. I see hedge funds using the stock price momentum coming from these forums to profit, and from that you won't hear much of anyone on Wall Street complaining. Now, if you found some original value to this video, click that like button. Thank you for doing that. It helps others see and learn from this video. We always discuss personal finance, business, and investing here at the Income Series. Become an original OG and subscribe to the channel, and you guys have a good day.